This is Peter. Peter is a 40-year-old businessman who just sold his technology company for €250 million. Peter now wants to focus on enjoying his life together with his wife and kids. This is why Peter is thinking about how he can invest his money. He has two options. He either founds a single-family office or invests his money into a private equity firm. In this video, our group wants to help Peter decide which option is better suited for his situation. So what is the difference between a single-family office and a private equity firm? Family offices are generally established by families with high wealth. Investments are done with own money gained by selling a family business, for example. Investments tend to be in a variety of assets, for example, real estate, bonds, or company shares. The main objectives of a family office include wealth preservation, management of family affairs, as well as planning and education of the following generation. Private equity firms are mostly established by business professionals. They invest money funded by institutional investors like pension funds. Investments can be in a variety of assets, but tend to be majority stake company acquisitions. The main objective of PE firms is maximizing profits. We're now going to look at an example of a German single-family office. Athos Partners is a German SFO founded by the twin brothers Andreas and Thomas Strüngmann. Their wealth came from the pharmaceutical company Hexal, which the brothers sold in 2005 for an estimated €6 billion. They got assistance from the SFO management and were flexible in their decision making, which allowed them to do the initial financing for BioNTech, which turned out to be a major success. The SFO continued with a venture capital strategy. It purchased the Südwestbank, converted it, and sold it for profit in 2017. This shows that the combination of management and flexibility of the Athos Partners SFO led to sustainable returns.
If it isn't already clear enough, you will now see that even though SFOs are more and more serious competition for PEs, they differ quite a lot from each other. You can see the difference between those two company types by looking at what success means for them. So let's begin with the SFOs. Now if we take a look at our success rocket here, you find topics like succession planning, synergies, and asset allocation. Overall, you can clearly say that these ambitions of SFOs differ a lot from PEs. Their main goal is capital preservation of future generations. This shows quite clearly that SFOs are only committed to their families. Peter shares this philosophy since it is one of his main goals to preserve his fortune, and he wants to enable his kids a bright future with it. Further than that, another important part are non-financial goals for SFOs, for example ESG criteria or other family value. If we now compare that to the success factors of the PEs, the main difference is that the PEs are exclusively financially incentivized. Therefore, they are more return focused. As we will see in the rocket, success for the PE means know-how, structure, liquidity, and more like corporations and partners. If those factors aren't existing, PEs won't hesitate to restructure the company without consideration of losses. However, a big PE company like the Blackstone Group probably won't focus that much on ESG criteria of the investment or a good relation with the family of the acquired company, but rather on a higher return.
So now you heard about the success factors of SFOs and PEs. But what does success exactly mean? So for single-family offices, success means having a long-term plan and direction for the family with a hassle-free management of all affairs. Also, preserving and increasing the family's wealth while fostering entrepreneurship and educating the next generations. For PEs, on the other hand, we more or less only see the maximizing of profits as success. But also entrepreneurship and positive impact play a role for many PEs. All in all, the definition of success differs essentially between PEs and SFOs, but both want to have a positive impact in most cases and of course want to maximize their profits. It is also important to note that both have different risk attitudes, investing strategies, and return expectations. Therefore, even the factor of profit differs. As an outlook, we see that more and more SFOs are shifting towards a PE-like definition of success, with similar investing strategies. So let's come back to Peter now and see what kind of vehicle would fit his needs the best.
Peter wants to focus on stable returns as well as planning and education of his kids, rather than focusing purely on profits. Therefore, he decides to found his own single-family office instead of investing his money into a private equity firm.